Have you ever wondered what truly defines control in a private company investment, especially when you are not buying the whole business? It is a fascinating area where percentages speak volumes about influence. In private equity, a minority equity investment typically refers to an ownership stake that is less than 50% of a company's outstanding shares. This threshold means the investor does not hold outright majority voting control. The core reason this percentage is significant is due to corporate governance structures, which generally assign decision-making power proportionally to equity ownership. An investor with less than 50% cannot unilaterally pass resolutions or appoint the majority of the board of directors. For example, a stake between 20 and 49% is often considered a substantial minority, granting significant influence but rarely absolute control. Meanwhile, smaller stakes, perhaps 5 to 19%, might only offer board representation without strong veto rights over strategic decisions. This distinction is crucial for understanding the power dynamics within a company. Practically speaking, this means minority investors must rely on strategic partnerships and carefully negotiated rights to exert influence. Rather than dictating terms, they often collaborate with majority shareholders or other minority investors to achieve their objectives. Companies seeking minority investment typically value the capital and strategic guidance without relinquishing full operational control. Therefore, the focus shifts from direct control to influencing through representation and contractual agreements. An interesting nuance here involves what is known as negative control or protective provisions. These are specific contractual rights, often included in investment agreements, that allow minority shareholders to block certain actions even without majority voting power. Such provisions might prevent a sale of the company, approval of significant capital expenditures, or changes to the company's bylaws, offering a crucial layer of protection and influence for the minority investor. Understanding the precise ownership percentage defining a minority stake, along with the associated rights and limitations, empowers both investors and companies to negotiate more effectively. It highlights the importance of governance structures and tailored agreements in private equity, ensuring all parties comprehend the real extent of their influence and decision-making capabilities.